Dear learners, welcome back to Ratio Analysis. As we all know, the primary objective of every business is to earn profit. And without this profit, no business can survive. So it is very essential that to analyze the profitability position of a company. Here I will discuss those profitability ratios which can be useful in measuring the profitability position of a company. They are gross profit ratio, operating ratio, operating profit ratio, expense ratio, net profit ratio and cash profit ratio. We will discuss each ratios in detail. First we will see gross profit ratio. So this ratio measures the relationship of gross profit to net sales. So from this word itself we can derive the formula for calculating this gross profit ratio, that is gross profit divided by net sales. And usually we represent these ratios, that means all the profitability ratio in percentage. So we multiply the same with 100, then we will obtain the gross profit ratio. Then how can we calculate this gross profit? So gross profit can be obtained when we deduct cost of goods sold from the sales. So gross profit means sales minus cost of goods sold divided by net sales, and net sales means sales minus sales return. If the company has any sales return, then that we need to deduct from the total sales, then we will obtain the net sales. So this is how we calculate the gross profit ratio. And if we deduct gross profit ratio from 100, then we will obtain the ratio of cost of goods sold to sale. Suppose if you want to calculate the cost of goods sold to sales ratio, then we can deduct this gross profit from the 100. That means the general equation is sales minus cost of goods sold is gross profit. So if you want to calculate this cost of goods sold, then how can we calculate? Sales minus gross profit is the cost of goods sold. So if you know the percentage of this gross profit, for example this gross profit is 20%, then what will be the cost of goods sold? 100 minus 20%, which is 80% will be cost of goods sold. So this is how we can calculate cost of goods sold to sale ratio. Then how can we interpret this gross profit ratio? For this profitability ratio, there is no standard rule or rule of thumb. We will analyze each ratio with the help of the type of industry or nature of industry, the business and all. So there is no standard norm for interpreting gross profit ratio, but generally higher the ratio or higher the gross profit ratio, better is the result. Why we say the when the gross profit ratio is higher, that is more favorable? Because from this gross profit, the company has to cover all the operating expenses and the non-operating expense. So the gross profit should be adequate to cover the operating expense and to provide the fixed charge, dividend and accumulation of reserves. And that is why we say higher the gross profit ratio, better is the result. Now we will see the second type of profitability ratio, that is operating ratio. So this ratio shows the relationship between cost of goods sold and other operating expenses on one hand and sales on the other hand. And this ratio also represent in percentage. So operating ratio equals operating cost divided by net sales, and we know how to calculate this net sale, that is sales minus sales return. And how can we calculate this operating cost? Operating cost includes what all things? the cost of goods sold and operating expenses. So when we calculate this cost of goods sold plus operating expenses, we will get the operating cost, and operating cost divided by net sales will obtain the operating cost. And this operating cost, it includes operating expenses. So operating expenses mainly include two items, that is administrative and office expense and selling and distribution expense. So administrative and office expense, it includes like rent, then salary, then insurance for the staff, etc. will be include from in the administrative and office expense. Then coming to selling and distribution expense, it includes all the advertisement, then salary of salesman. So this kind of things will be included in the selling and distribution expenses. So when we add these two items, we will get the operating expenses. So this is how we need to calculate operating ratio of a company, that is operating cost divided by net sales. Operating costs include cost of goods sold and operating expenses, and operating expenses include these two items, that is administrative and office expenses, selling and distribution expenses. And now we will see how to interpret this ratio. So here, higher the ratio, less favorable is to the business, because it talks about the operating cost or operating expenses. So it is always better to have a low operating ratio as compared to other ratios. So this is how we interpret operating ratio, and here also there is no rule of thumb for interpreting this ratio, and we interpret the ratio by comparing the type of business, nature of industry, then the type of product they are selling, then economic policies or economic conditions, etc. And now we will see operating profit ratio. And this ratio is calculated by dividing operating profit by net sales into 100. And how can we obtain this operating profit? When we deduct operating costs from net sales, we will obtain this operating profit. And how can we calculate this operating cost? When we deduct these items, that means all the operating expenses, that we can say operating expense from the net sales, we will obtain operating cost. And operating expenses include cost of goods sold and administrative and selling and distribution expenses. So when we deduct all these items from net sales, we will obtain the operating profit. Or if you have already calculated operating ratio, then we can deduct the same from 100, then we will obtain operating profit ratio. And this operating profit ratio, we can interpret higher the ratio, greater is the profitability, because it talks about the operating profit. So it is always better to have higher the ratio. Now we will see the expense ratio. It is very easy to calculate because it shows the relationship of various expenses to sales. So the equation is particular expense divided by net sales into 100. That means if you want to calculate the expenses ratio of cost of goods sold, then here we can write cost of goods sold divided by net sales into 100. Or suppose if you want to calculate administrative and office expense ratio, then this particular expenses divided by net sales. Or if you want to calculate selling and distribution expense, then this particular selling and distribution expense divided by net sales into 100 we can calculate. Or if you want to calculate non-operating expense, then how can we calculate non-operating expense divided by net sales into 100. So this is how we can calculate the expense ratio. For every expense we can calculate individually the ratio. That is, for cost of goods sold we can calculate, administrative and selling expense we can calculate, selling and distributive expense we can calculate, and non-operating expense also we can calculate this. So what is the question? Apply that in the numerator, divided by net sales into 100, we will obtain this expense ratio. And how can we interpret? Obviously it is a expense ratio. So lower the ratio, greater is the profitability. And now we move on to net profit ratio. And net profit ratio shows the relationship between net profit after tax and sales. So net profit after tax divided by net sales into 100, we will obtain this net profit ratio. And how can we obtain this net profit? Net profit is obtained after deducting income tax and excluding all the non-operating income and expense, then we will get the net profit. So higher the ratio, higher is the profitability, because it talks about the final one, that is net profit ratio. So it is always better to have the higher ratio. And the last one in the profitability ratio is the cash profit ratio. So this ratio shows the relationship between cash generated from operations to net sales. And the equation is cash profit divided by net sales into 100. And how can we calculate this cash profit? Cash profit equals net profit plus depreciation. So when we add this depreciation to the net profit, then we will obtain this cash profit. So this is all about the profitability ratios. I hope this is clear to you. We will see you in the next video with another type of ratio that is useful in analyzing the performance level of your company. Stay tuned. Till then, keep learning. Thank you.